Introductory terms to the stock market game. A stock. A stock, and that's what they were talking about in the video. They were talking about trading stocks. Stocks is a certificate of ownership and claim to the profits that a firm makes. Okay, you don't own all the stock for a company when you buy stock, unless you buy 100%. I'm not sure anybody owns 100% of the stock in any company, but you own a part. Actually, there's thousands, usually, typically large company, thousands and thousands of stockholders, right? And you may own 10 stocks, you may own 1,000 stocks, okay? But it's a partial ownership of a company, is a stock, okay? A company whose stocks are traded on the stock market has gone from private ownership to public ownership. So they were talking about capital, right? By going public, you create capital for your company because, if you're a private owner, you have to have the funds, raise the funds or have the funds to invest in your company, to buy, to expand it, to buy equipment, to pay the workers and all that. Well, if you go public, then when a private citizen buys a stock in your company, the money they go to buy that stock, that becomes capital for your company. The company now has, and you have all these stockholders who buy the stock, then the money from the stocks goes towards the company, can use that to buy capital, hire workers, buy machinery, invest in their company and make it grow. Okay, so that's the reason why a company typically goes from private to public, to have more capital available to grow their business. When they go public, it's called an initial public offering, IPO. Anybody heard of that before? Okay. If you follow the news, every once in a while they'll come out with a big IPO. Like recently, last year, I think it was Facebook. Alibaba was another one. That's actually a Chinese company that went public. I think it broke the record for the initial amount of value of the sale. But it's an IPO is the first time the stock of a private company is offered to the public. IPOs are often issued by smaller, younger companies seeking capital to expand, but they also can be done by large, privately owned companies looking to become publicly traded. And as I said, Facebook and Alibaba are recent examples of that. Any questions on IPO? Okay. Stock investment approaches. Okay. We're going to play the stock market game for 2 months. That's really not realistic. That's not enough time to really get gains out of a stock unless you really hit one that you buy it really at a really cheap price, and for some reason all of a sudden its value goes up. They get a patent or something, or they invent something new. But you can still, it'll be a snapshot, but you can still get an idea, and you can still research and see, they may be saying right now this company is growing, okay? Well, in over 2 months you may see some growth. So there are two investment approaches, like if you have a financial advisor, like Mick, our speaker. When I sat down with Mick the first time, he said, okay, we can go for aggressive growth and income, and then one of the choices was like I forget what they call it, but like you're gaining wealth to pass it on to your heirs. Okay, so you can invest with different approaches, but the two main things, one is growth. Okay, so growth, people that invest for growth, okay, they buy some stocks and they hold on to it, and then they plan to sell it when it at a higher value than they bought it. And typically that's a longer term type investment, growth. Okay, so that's how you're going to gain from the investment. By the growth of the stock, it's increase in value. You sell it more than you bought it for. Another approach to buying stocks is income. Okay, and if you have an income approach, that means you buy this stock and you want to have a flow of income from that stock that you own, from the ownership of the company. And you do that because companies issue dividends, okay? And so, every year you'll get so much in dividends from owning that stock. And there are stocks, you can specifically target stocks that have high dividends versus those that don't, okay? So that's another approach, the income approach to investing in the stock market. So let's talk about what a dividend is. A dividend is a distribution of a portion of a company's earning paid to the shareholders. Okay, so the board of this company, board of directors, they're going to say, okay, this year we're going to pay so much in dividends to our shareholders. And it's part of their profit. Okay, so the shareholder is the owner of the stock. Okay, that when you own a stock, you have a share in the company. Okay, so yeah, the earnings are paid to the stockholders in the form of a dividend. Investment strategies, long term. Okay, long term, and that's typically people. Unless you have lots and lots of money to invest, most people invest long term in the stock market, and that is when you gain from the increase in the stock's values over a number of years. Okay, so I started investing in my late 20s, right? And some of those stocks I initially invested in, I still have them. They've just grown over time, and then when I retire, I'll cash them in, and hopefully there's been a lot of growth, and that's will add to my wealth from investing in the stock market. Okay, so that's the long-term approach. Okay, in the long-term approach, you want to consider over the long term. It's going to go up and down, but you hope the general trend of the stock you own is that it'll gain 10 to 12% a year. Okay, 10 to 12% a year is considered a good return on your stock. Now that's a nominal growth. Okay, so you say, okay, I'm doing well if my stocks gain 10% a year, but actually it's more like 7% because inflation's usually around 3%. So a real growth would be more like 7%. But and then you get into the rule of 72 where you can figure how long it's going to take your wealth to double, right? You divide the interest rate into 72, and it tells you how many years it's going to take for, if I initially invested $10,000, it'll become $20,000 at 10% growth in X number of years. Long term. Okay, the short term. Okay, you may hear of day traders or people that are constantly buying and selling stocks, right? And that's when a shareholder tries to time the market so that he or she buys a stock at a low price and sells it at a high price in a short time frame. Okay, maybe within a couple of years or less than a year. Okay, a extreme example of this is penny stocks. Okay, penny stocks are like, you typically go through a broker, and he finds a company in Africa that's mining, like a mineral company, right? Just starting out. Okay, that company isn't worth anything. They haven't really, mined anything. You buy real inexpensive stocks in that company, and then all of a sudden they find a gold mine, right? Or they find some mineral, rare mineral, and they can mine a whole lot of it. Well, their stock may grow 1,000%. So you buy it real cheap, and then their stock will expand all of a sudden, and you sell it. You make a windfall profit. That's short term. It's more risky. Okay, it's like I said, typically people will have a lot of money to invest. They're the ones that do short-term trading. Everybody understand? Okay. All right. So finance, yahoo.com. I tell you what, we'll look at this next time. You may look at it, go and check it out yourself. It's got all kinds of information on the different exchanges in the U.S., how much they've grown. You can type in individual stocks, and it tells you its growth and information about that company. So we'll investigate that next time. I want to finish this PowerPoint. But that's just one website where you can find financial data on the stock market. A bond, okay? So in the stock market game, you can also buy bonds, okay? Bond is a promise to pay specific sums of money at specific dates. It's an IOU with interest, okay? So if I'm a city of Greenwood and I want to build a park, right? To get money to build this park, I would sell bonds to. There's people out there that buy. That would be a municipal bond. They'll buy a municipal bond. Okay, so they may buy the bond may be worth $10,000. So I'll sell the $10,000 bond, right? And then when I sell that bond, that means over a period of maybe 30 years, I'll pay back that $10,000 plus interest, an agreed upon interest rate on the bond, plus interest, okay? And so then, that the person that bought the bond hopes to gain from the interest that they'll earn from selling the bond. And then, that goes into what we were talking about. It depends on inflation, whether who's going to, if the person that buys the bond is going to really gain from it or not. But that's how a bond works. So it's used by companies, municipalities, states, and sovereign governments to raise money and finance a variety of projects and activities. Bonds are a more conservative investment than stocks. They're safer. All right, they're not affected by the market as much. Okay, bonds typically yield about 3 or 4% growth. That's the rate you're going to get on a bond. But one thing they talk about when you buy stocks, you typically buy a diversified portfolio. You balance out. You may have 80% stocks in your portfolio and 20% bonds. Okay, it balances out the risk. When stocks go down, bonds values typically go up. Mutual fund. Okay, a mutual fund is an investment vehicle made up of a pool of monies collected from many investors for the purpose of investing in securities such as stocks, bonds, and money market interests. Okay, so that's what a lot of people buy mutual funds. It diversifies the risk. Okay, since you're not investing in just one company, right? That you're invested in many companies in a mutual fund. So if one fails, the others don't, then you don't lose. If you invest in one stock, if that company goes bankrupt or fails, then you lose all that. You lose all that money invested in the stock. So, but mutual fund, you invest in many companies. There's many investors, so that there's enough people pooling their money to provide capital to the companies in the fund. There are many stocks and bonds that's typically managed. Okay, they're managed by a person that they specifically research that market that the mutual fund deals with, so they have knowledge. Sometimes knowledge about what's going on, and they can make a wise investment. You don't have time. I don't have time to research all these companies that I'm investing in a mutual fund, but a manager does. Okay, but there's also index funds where you can just go and invest in the index, and those have done as well as managed funds. So diversification of mutual funds lowers the investment risk. One company wanting to fail will not sink the entire fund. Okay, and then a money market account is just like a savings account. Okay, except it has a higher interest rate than a savings account, but you can't. It's not as liquid. You can't write checks as easily from a money market account. That's why they can give you a higher risk interest rate, and you will be able to invest some of your money from the stock market game. If you want to, you can put it in a money market account. All right, so it's a type of savings account. All right, that's it. We'll see you next time. Get the reading done for homework.